And it doesn't change. And everybody speaks to not being part of the herd, but I'll tell you, everybody's part of the herd. And it's very difficult to find capital today. And sellers or owners aren't really willing to discount too much in order to execute a transaction because they believe that the market's going to recover. Interest rates are going to come down further,
Right.
recover. So it's at a stalemate.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this YouTube podcast series, Real Estate Market Watch, current events through a real estate lens. My guest today is Chris Garner, who is president and CEO of Avanti Residential. Avanti own or manage in excess of 10,000 units, multifamily units. Their focus is on core plus and value add, although they're starting to migrate into some affordable housing asset class as well. You're going to hear about all of that today from Chris. Chris has a lengthy background in commercial real estate, going back just about as far as my career as well, actually, into the early 1980s. So he has a perspective that is born from having gone through several major downturns over the decades that lends itself to his investment philosophy and thesis. Again, you're going to be hearing about that today. All extremely interesting today in particularly uncertain times, but as we pull out perhaps of a recent downturn and look to the future, how to invest prudently, and really how to win at the multifamily game. You're going to be hearing all about that today in the show. If you've not already subscribed to my newsletter, please go to GowerCrowd.com, sign up there. You can always unsubscribe. I write summaries of the podcasts and share capital formation tactics and tips on occasion as well there in the newsletter. Comes out as often as I'm doing these podcasts actually at the moment, so about once a week. All there at GowerCrowd.com. Okay, that's it. Let's move on. Chris Garner, President and CEO of Avanti Residential, coming right up now. Chris, it's always a pleasure to see you. Thanks so much for joining me on the podcast today. Oh my goodness, your first ever podcast. I'm so flattered and honored that you would join me for that. All right, so I'll tell you what, why don't we start off with kind of high level. Tell me, what is Avanti? What is your asset class focus? Give us a sense of scale.
Okay. Yeah, good morning. Adam, Avanti Residential is a privately owned owner-operator of multifamily. We solely focus on multifamily, but within that asset class, we are invested in both market rate apartments as well as affordable apartments.
And scale? How big?
Yeah. We own with investors about 8,500 units in 7 states, and we manage an additional 2,500 units, most of those here in Denver. We're not fee managers, but we strategically accept these assignments from the three investors that we work with on a fee basis.
So those investors, are they JV investors when you say 3 investors, or are they also partners with you?
Actually, on the fee management side, the clients, if you will, one is a friend of the firm with one asset.
I see.
The other is a property that we sold a couple of years ago to a fellow that I had a relationship with, and it was a strategic location within our Phoenix region, so we just managed for him. And another is a personal relationship that we manage. I think we're up to 19 properties for them. They do not have a management division, and the strategic reason for that is that those properties contain 80 to 100 units, so they're smaller sized than our typical properties. And we're managing those to really learn more about how to scale in smaller properties.
Really? That's interesting. What are the challenges then with like how do you scale, and what's kind of the minimum size that is a good size for
The good size is what we refer to in the business as an institutional size, or properties closer to 200 units and larger. And the primary reason is that the cost of the staffing can be amortized over a number of units. So it's just more economical and efficient to operate. These properties are, they said, 80 to maybe 100 units, and it is inefficient if you have a manager on site and maintenance people on site. The per unit salary and compensation costs are just too large. So the challenge is, how do you manage effectively? How do you provide the residents the service and the experience of having someone on site, but do it in an efficient manner?
So how do you do that with 80 unit apartments?
With the introduction of AI here in the last year or so, there are software platforms that have been created that make it much easier to provide a personal experience to the resident, but doing so through a centralized location, which is typically a corporate office. So we have dual site managers. I still want an adult at the properties, but instead of being there every day, maybe they split 2 or 3 properties and they're there 2 or 3 days a week. And then incoming calls are handled through AI and a bot. And it's actually quite good. In many cases, it's getting to the point where it's difficult to determine if you're speaking to a human or to technology.
That's incredible. Now, you guys are quite forward thinking with AI, aren't you? Correct me if I'm wrong, you have an investment arm or...
Yeah, no, we are. Our owner's son, who's in his late 30s, is very focused on technology. He has started and continues to own 2 tech-based real estate companies, and is very focused and passionate around creating efficiencies and growing Avanti through the use of technology. So we make investments in prop tech, primarily to, witness new products early on and have an opportunity to pilot these programs. Being 12,000 units, we're very nimble compared to the behemoths in the industry. So it's easier for us to pilot some of these programs. And I really believe that to be an early adopter of this, the whole industry is going in this direction. And to be an early adopter, it's going to be much easier for us to be a leader and be competitive once this really permeates the business.
It's interesting because I've been reading a lot about this question of whether or not AI is actually profitable. There's a lot of talk about AI being a bubble, propping up the economy, and who's actually making money out of it. Is it a cool gadget? But it sounds like you are actually driving bottom line numbers with it, especially with the management applications that you've been describing. Can you talk about that a little? Are you seeing actual revenue enhancements or cost enhancements through the use of AI?
Quick answer is not really, but the reason behind that is that we are still transitioning into this new operating platform. Also, at 12,000 units in 7 different states, we don't have the scale that's really necessary in a regional location to fully benefit from the AI. I will share that at the top line basis, I think we're realizing benefits on the top line, on the revenue side today, much more so than we're saving any costs. In fact, I'd say our costs right now are probably higher than they were before. But our turn times, our ability to deal with delinquencies, our leasing processes are all much faster and accretive to the bottom line. So as an example of that, instead of having a leasing team at each property, And I'm not saying the leasing of those who take a prospect through the units, but it's more on the application side and the credit reviews and so forth. That's all being done in our corporate offices regionally. And there are a couple benefits from that. One is that, in our business on site, we hire people that we expect to be very good extroverts and salespeople that can, take prospects through the properties and really, provide a great experience. And at the same time, we expect those same people to be really good with financial analysis and reporting. And it is very rare that you find somebody that is good at both of those type of disciplines. And the centralization allows us to specialize these roles more. So the people on site, I like to think of them as a concierge at a hotel. That's what we're trying to create, is that type of service at the property. And the other work product that we ask these people to perform is now being brought into the office through centralization and new technology, and AI is really helping create a better experience for the residents.
It's fascinating, isn't it? The impact. I mean, the idea that you could be using bots that are indistinguishable from real people is incredible, actually. Now, as far as so you talked about affordable housing as well, but this is a relatively new initiative, isn't it, for you?
It is.
Chris, what's the story there?
The foundation story is we have a founder who's very philanthropic. He's been successful and is very grateful for his success. And as he shares in the company, he wants Avanti to be part of the solution rather than the problem to not just homelessness, but just the inaffordability of housing. And so we raise a lot of money through charitable efforts. Doug is very philanthropic and wants to start a nonprofit and affordable housing divisions in the company. So we hired a gentleman who's has a lot of experience in LIHTC development, which is tax credit development. He's based in Tampa, Florida, and we just started that division earlier this year. But we have, I'd say, 5 properties, 3 of which are coming out of the ground next year. So we've hit the ground running in this business. It's interesting. I wasn't aware of this, but I was in Phoenix last week touring a couple properties that we have tied up and that we will be building, and one of them's in joint venture with another developer, and he made the comment that Avanti is the only market rate and affordable multifamily player in the Phoenix market. We're the only ones that are doing both, and that was a big surprise to me. So I'm very proud of that.
So you do so the affordable that you're doing is I want to say with a capital A, by definition, not by design. Is that right? So we talk about lighting.
Yeah, it's definitely by definition.
Right. And it's fearsomely complicated. I remember those LIHTC. I've seen the LIHTC stuff. It's just incredibly convoluted and bureaucratic from what I can remember. And you have to hold them for 10 years or 30 years or something. They're deed restricted and all kinds of things.
Restriction periods have elongated over time. They're much closer to 30 years now.
30, right. Now, are you also doing some are you doing some ground? Your main focus is core plus and value add, right?
Yes. Yeah. The company was founded and the bulk of our business is really acquiring existing multifamily, market rate multifamily, and creating value. And depending on what market and what point in the real estate cycle you find yourself in, that execution or value proposition is different. So I think we're a little different than a lot of our competitors in that we don't focus solely on value add, which is, the traditional value add is improve the interior surfaces and the interiors of the properties and the exterior common area, and raise rents for that enhanced product.
Mhm.
We certainly do that when we believe the time is right, but in many instances and during cycles such we find ourselves in today, a renovation strategy doesn't really work, in my opinion, and in our experience. Residents don't have the additional disposable income to pay for a stone surface over a different type of surface. And most residents during tighter economic times are really just looking for a good, clean, safe place to live. And so during cycles like we find ourselves in today, we're investing in growth markets and bringing our management expertise to bear at the properties and creating a better living experience for the residents.
I'm so happy you teed up my next question so perfectly. All right. So what point are we at in the cycle, Chris? So where are we in the cycle? And actually, I have to also, I hate to do this, I shouldn't do it, but I'm going to ask a double-barrel question. What point are we at in the cycle? And it's interesting to me to hear you saying, actually, we'll come back to residents being unable to pay the additional rent. Let's come back to that. What point are we at in the cycle?
We are, I think, for the most part, on a national basis, we're through the deterioration part of the cycle. And I would say that we are at the bottom, if not the beginning of the recovery. On a regional basis, it differs because there's been a lot of new supply delivered in many of our major markets since COVID. And it's that excess supply that needs to be absorbed. And so it was a supply issue this cycle that caused the deterioration of the fundamentals. And that's great for the residents because rents have come down, concessions have been introduced in the market, and the effective rents are definitely down from where they were, a couple of years ago. So the residents win. But we're coming into a part of the cycle where this new supply it's either the peak has either been delivered in the market, such as Nashville, or the peak is being delivered right now. And you could point to Miami, you could point to Denver, you could point to Phoenix. And so on the ground, I think the fundamentals are going to deteriorate a little further. And that's probably through next year. But investors will begin to see the light at the end of the tunnel. And I think the liquidity in the market will recover very quickly once investors regain their confidence. And my expectation is that happens sometime next year.
So the fundamentals, when you talk about the fundamentals improving, what exactly are you talking about? You're talking about supply being absorbed or other economic factors?
In that comment, I'm speaking to occupancy, lease, time to lease. It's more on the demand side of the equation.
Demand side. So it's curious to me, and on that side, you've talked about residents not having the income to pay the accretive rent when you do some, if you put in a fancy countertop or whatever. So what are you seeing in the market as far as the general macro trends are impacting lease ups and your investment decisions?
We were very lucky as investors this cycle that jobs, remained intact. There was not a big loss of jobs. So the property, the downward economic pressure we felt as owners really was due solely to new supply and excess supply, and the use of concessions, which started as a week or two, and in a number of markets today, it's 2 months or more, actually drove a lot of absorption. So the new supply was absorbed, but the effective rents of new leasing has definitely deteriorated over the last couple of years. I'd say renewal leasing is probably pretty flat. So those residents that elect to stay in their unit when lease expires, those rents have remained fairly flat, but new leasing is down. And it differs in each market. It may be, 2%, it may be 5%, or, up to 10%. It on an effective basis. It just depends on the market.
All right. So what markets, you mentioned 7 states. What markets are you in, and which are overperforming, which are underperforming at the moment?
They're all underperforming.
Are they really?
Yeah, they
Really?
all, and I'll certainly share the markets we're in, but we focus on a strategy, on investment strategy of growth markets. And it was in these growth markets that developers sought to build new product. And it was in these growth markets that the great migratory, change that we experienced through remote work and COVID allowed people to move to markets that they wanted to live and enjoy life in. And because of that, a lot of new supply was delivered in markets such as Denver, Phoenix, Miami. And post-COVID, actually, we saw a number of our residents repatriate back to their states of origin as companies sought to bring people back to the office, and that impacted demand at the same time that a whole bunch of new supply was being delivered. So yeah, our markets, our first market, the company was founded in Denver. So Denver is a big market for us. The investment cycle then progressed to Phoenix in about 2015. We're also in Salt Lake City. We expanded in right after COVID into Kansas City and Miami at about the same time. So South Florida and Kansas City. And since then, we are growing into Nashville. We're looking in the Carolinas right now. Generally, the Southeast Sun Belt is where I'm driving the growth of the company, and really expect to have the largest portfolio, say in 10 years, will be down the Southeast Sun Belt.
Okay, so why those markets particularly?
Very job friendly, growth friendly, from affordability to quality of life to regulatory pressure as private property rights, political issues, a whole host of reasons. We're picking markets it depends who our investor is. We went into Kansas City with some legacy investors because they were seeking more stability and a predictable quarterly dividend. And so we own 8 properties in that market now, and it's been terrific. It's actually really outperformed what we had expected the market to do. And at the same time, we allowed that same group of legacy investors to invest in South Florida, and many of them split their investments between the 2 markets. And we went into South Florida because it's known as a more growth-oriented, volatile market that experiences growth and deterioration, and higher returns over a long period of time. So that the investment strategy informs our decisions on where we invest.
Interesting. Investor strategy.
Yes.
Yeah. So what are characteristics in Kansas have taken you by surprise that so everything over there is outperforming?
In Kansas?
Yeah, you said that everything there is outperforming Kansas City, right?
Our business has become more and more reliant on third-party forecasters in the last 15, 20 years. And through a consolidation, that field is now, less than a handful of forecasters. And Kansas City was forecast to experience, say, 2% growth over the period. And I think we picked 3%. And Kansas City drew me. I'm from the West Coast originally, and had an opportunity to consult for some investors in Kansas City. And I was floored by the quality of life and there was and the affordability there. So when I came to Avanti, I took that opportunity to invest in that market, and it also was not an institutionally friendly market. There weren't a lot of institutions in that market, so there was a gap between cap rates and interest rates, a better arbitrage in that market than in other institutional markets where there was more competition from the buyer pool. And we expected that Kansas City would attract institutional investors over a 10-year period. We typically buy for a longer hold period. And we experienced it. The market outperformed because within 2 years, the rent growth was almost double digit. And that double digit rent growth attracted a lot of institutional investors, primarily because they weren't overbuilding with new supply in the market. So it remained a pretty tight market. I think they replicated, less than 7% of the inventory through the build, whereas in many of our markets, there was more than 15% of new inventory delivered. So, half of what many of the other markets experience. And so combined, it's remained, the fundamentals have been pretty good. Now, that's not to say that a number of our properties haven't suffered, and because of the new supply that's been delivered in those markets, but overall, it's been an outperformer for us.
Chris, what are you seeing on the acquisition side? What are you seeing in the market today? Is there any distress? I mean, you've talked about, you guys are robust, and although your properties are underperforming, you're not losing them, right?
Yeah.
But we are seeing that in the market. What are you seeing in your markets in terms of distress and opportunistic acquisition?
So it may be helpful to understand what in a normal year we buy and transact. So
Okay.
we would probably, and I think in a normal year, we'd buy 8 properties. So during 2021 to 2023, we were transacting about $1 billion a year. So pretty active in the market. We are seeing nationally transaction volume off by 80%. And that's been the case for 3 years. Largely because of a combination of much higher interest rates, which drive cap rates. So the value has fallen because of the cap rates. And because of performance. The new supply led investors to worry about growth occurring in the first couple of years of investments, would slow down their enthusiasm to enter the market that time. None of that has really improved. And on the other side, because you have so few deals transacting, there are some buyers out there that still really need to buy for whatever reason. And cap rates have stayed very low. And this is a generalization, but for Class A multifamily in a primary market, I mean, we've seen cap rates stay in the high 4s. And that's when borrowing's been in the mid 5s. And so huge gap between, a negative gap. And so I don't have the confidence or the outlook to invest with that kind of negative leverage. So we haven't bought anything this year. We've sure been trying. Actually expanded the size of our investments team because I personally don't believe going to the sidelines. I just believe working harder and finding those opportunities. So we actually expanded our team. We bought 3 properties last year. And we're pursuing a couple now. I think what we're experiencing today is a deterioration in operating fundamentals, and that is the occupancy and the rents, the effective rents being achieved at the properties. The immigration policy.
Right, I was just about to get there. Other than supply, immigration, tariffs, any other macro?
Yeah, it's a little anecdotal, I'm afraid, but boy, the demand fell off this summer dramatically. And I think because of immigration fears and enforcement, there's just less activity of people out moving around.
Really?
And the amount of demand in our properties in Florida, in Denver, really in most markets, but those of our markets really stand out, has really fallen off.
Really?
Yes, and I think that that demand side of the equation will remain somewhat weak into next year. So that's put a lot of investors on the sidelines that were talking, earlier this year about getting active by the end of this year. And I think it's pushed it into next year again. There is not a lot transacting. Cap rates have stayed, I'd say cap rates today for the product we're looking at are probably up into the low 5% range, and debt is, call it 5%. You can buy it down less, but you're in a much better position in leverage today. But we're not seeing strength in the market, so it's still pretty much crickets out there in terms of transactions.
Wow, it's incredible. And no opportunistic or distress you're not seeing?
Very little.
Really?
Very little. And our strategy today, I think it's worth noting, is a recovery play. So I'm looking for newer assets that are built, 2000 or newer, that are in good physical condition. And some kind of a rent recovery play. Either it's the absorption of units in that submarket, and rents will once again increase, get some traction. And then a bunch of little levers to pull: management, maybe a light enhancement of the units, exterior work. You pull 3 or 4 value levers to get a return. And they're out there. It's just very, very difficult to find capital today. I've been in this business for 40 years, and it hasn't really changed. When times are tough, everybody hides. And this is really a great time to be investing, but the amount
we've talked about this, isn't it? The ultimate irony that the perfect.
And it doesn't change. And everybody speaks to not being part of the herd, but I'll tell you, everybody's part of the herd. And it's very difficult to find capital today. And sellers or owners aren't really willing to discount too much in order to execute a transaction, because they believe that the market's going to recover. Interest rates are going to come down further, right, recover. So it's at a stalemate.
Do you agree with them? Do you think that interest rates are going to come down, and that cap rates will compress and values will go back up, and we're going to get back to glory years again?
Well, I'll preface this by saying I did fixed rate financing for 20 years during a period when interest rates only went down. So I'm probably the wrong one to ask.
You are the right one, because you know why? You're still standing, Chris. That's exactly right.
I'm a real estate investor, and so I try to identify as much risk as I can and mitigate it. And financial engineering, I'd much rather invest in real estate than in the financial engineering, right? But I think if we end up with a 4% 10-year treasury, we're in a good place. I think we could transact today if there wasn't so much fear and volatility in the market. There's a very large part, at least half our country that questions or doesn't believe in what the administration is doing and is fearful of that. And it has locked up a lot of business, at least in our industry.
Well, you just want to find all those that think that the world is going to be fabulous and buy from them.
They do. You know, I'm
But the other, how the other half lives.
I'm not going to bet against the US. So I think
Mm,
this is a very good time to invest.
mm,
I do think you need a little bit of the long view. And we've talked about this before. You know, our industry is based around IRR and 5-year holds.
right.
And and that slows down investment today from a capital perspective because
Mm,
investors aren't confident that we're going to recover in the next 12 or 18 months that would allow for the a 5-year investment cycle
mm.
to realize the growth that they need to generate the IRRs that they need to provide to their investors. So, so we wait until people can see the light at the end of the tunnel. But in that interim period, I think it's a terrific time to take advantage of opportunities of buying, really well-built, well-located properties at well below their depreciated replacement cost. And that's a great strategy, but very little capital out there is brave enough to pitch a deal in their investment committee and say, I want to invest right now.
Okay, so it's interesting. Let's actually just drill down on that a little bit more because it is something you and I have talked about. And when we talk about investors, we're talking about institutional capital. So what is going on with the institutional world that is causing them to dial back so much right now and freeze liquidity, essentially? What are they seeing that
I think I've
perhaps
touched.
we're not?
There are two things. One is timing. Again, most of these investors are investing for a 5-year hold period,
Okay.
and they are just not confident that the recovery is going to occur in that time frame.
Are they worried that there's going to be another dip, a double dip as well in that time frame?
Some certainly have spoken to that, but I think it's more just the time frame. The most of the money that's been raised has been raised with an expectation of delivering a mid-teen return IRR. And in order to do that, there needs to be some, substantive value creation. It's either through interior renovation, a re-tenanting, market growth, something changing. And I just don't believe the institutional investors or the private investors see that opportunity. And prices have not, because they're the transaction volume is so low. There's enough demand that it's kept the cap rates low enough that you don't have the interim cash flow either. So these acquisitions are all back end loaded. So there's a lot more risk in the strategy, and they're just not comfortable investing today. And for the most part, I think that's probably right. But there are green shoots out there. There are some deals that make sense.
Mm-hmm.
But I think on top of that, there's just a lack of courage to sit at an investment table and pitch a deal. I've been in the institutional world, and there is something there is somewhat of a culture of preserving your job and maybe not and waiting for the recovery and the rest of your colleagues to be investing and feel safer,
Yeah, exactly. I remember when I was, as a side note, I was running a company in Japan, for Universal Studios doing development, and there was this one guy. I remember this one time, was this one fellow who was just the perfect consultant for the job, and I just wanted to hire him. He knew everybody, knew everything. And they just wouldn't let me. I had to go with a big name company who were like 10x the cost. It was ridiculous. They didn't have as an experienced people. And it was all about you can't go wrong if you hire this company, right? No one's going to blame you. But if this guy gets it wrong, you stuck your neck out, your job's on the line as well. So
Right.
you kind of protect your position. All right. So you've been in this business a long time, Chris. And I don't want to hazard to guess how long. I'll let you share that. But consequently, you've seen other downturns.
Yeah, I started in the early 1980s.
Okay, yeah, you and I, exactly the same period of time. Yeah, we came into the industry same time.
So I've seen a number of cycles, and I've worked in both the private sector as well as the institutional public company
Mhm.
sector. And so I've seen a lot of things.
Okay, so what have you learned from prior downturns that inform your investing philosophy today at Avanti?
One that stands out more than anything is long-term ownership is the wealth creator. One. Um, Two is to identify risk as best you can. And humans, I think, are very bad at identifying risk. I just don't think we're very good at that. Um, and then mitigating it as much as possible. And another lesson that I learned on the institutional side was, stick to the real estate and don't get too deep or too long in the financial engineering side. And
Mm,
long-term debt is, the more runway you can put in front of you, the safer you're going to be. And in many of these sectors, they do recover as long as you don't have to sell at the worst time. So I made a
mm,
comment earlier. I've used fixed rate financing, but
mm,
most of my career, I've fixed rate financing, low leverage that I could utilize that leverage and through the downturn and
mm,
experience and enjoy the recovery. I mean, it's not a real complicated business, but when you've been through 4 or 5, pretty
mm,
harrowing cycles,
mm,
you just take a little bit more of a conservative approach. And when things are
mm,
just rock and rolling, as I tell my team here that are comprised of mainly younger people that haven't been through a big cycle, I
mm.
told them all, 5, 6 years ago that look, the downturn it comes a lot later than you expect. But when it comes much faster. It's kind of like stretching a rubber band, you just keep stretching, but when you snap it, boy, it snaps. And it
Right.
takes a lot longer to recover than you ever experience. I mean, every cycle I've been through sort of matches that. Everybody says, "Oh my God, the cycle just crashed. I didn't expect it." Well, I'll bet you most people have been talking about it for 10 months at least before it happens.
Hmm.
And it seems to just last a lot longer. And we're in that stage right now. It just feels like this has been going on a long, long time.
Mm. So let's start wrapping up, but going into next year, a couple of major things. There's a lot of coverage just recently about deregulation back to pre-2008 banking standards that are likely to pump $2.6 trillion of more liquidity into the economy. And then we also have in the inevitability of significant, I mean, unless you disagree with me, but it seems like the inevitability of significant rate cuts, if not before, certainly after Powell is termed out in May. So, with more liquidity and lower interest rates, if you accept both of those assumptions going into the next few months, can we expect a burst of activity in the industry? And if so, how do we make decisions today about investing? So, two big assumptions there first. Do you agree
Yeah,
with
good
this?
question. And as I've sort of shared, um, I'm pretty conservative, and I
Mm,
really focus on the real estate and not so much the financial engineering side.
mm,
So look, I don't know if rates are really going to come down substantively or not. I think a 4% treasury would be a very healthy treasury for us. Certainly, if it's south of 4%, that's terrific. Cap rates on Class A multifamily today are tracking about 100 basis points over the borrowing rate and over the treasury rate. So pretty close to the actual borrowing rate. So if we could reduce that, I think owners might transact more. certainly a lower treasury would increase transactional volume, and transactional volume would balance and benefit the supply and demand on the transactional side. So cap rates might not come down as much as the interest rates, the borrowing rate would, because there's more product in the market to sell, if that makes sense. I'm certainly hoping for lower cap rates because that means more value, but I'm not banking on that, Adam. Really what I'm banking on is investing in good growth markets with good support, good medical, good education, good transportation, quality of life, in good product, using local expertise to be in the right place, and then manage. And the reason I like multifamily so much is it's not just a real estate investment. We have the opportunity to affect people's lives in a positive way, our residents, and I really enjoy doing that. It's not as much a business as, say, hotels, which is much more of an operating business really than real estate, at least the way I look at it. But apartments sort of bridge the gap between, say, an industrial property and a hotel, where we really get to affect people's lives. And if you do that well, and you do it over a long period of time, you have an opportunity to materially set yourself apart for the competition. And that's another thing that I really focus on with our capital, is trying to find like-minded capital that is willing to invest for longer periods of time than maybe our competitors, because then I have a greater opportunity to affect that bottom line through creating a better living experience for our residents. If you're only owning a property for 2 or 3 years and then selling, you just don't have that opportunity to really affect the culture of the properties. Create friendships among residents. You know, if most people, there's over 50% of the country that they can't identify one best friend. And if we can, at the properties, help create relationships, we're going to have much stickier resident bases. We're going to, we can create amenities that are important to the residents beyond just a fancy gym and a swimming pool, if you follow that thinking. So that's what gets me out of bed in the morning, is trying to drive the culture of the company and our properties in that direction.
Well, you know, I got a couple more questions, but we should leave it right there. But on that note, that's such a positive note, seriously. Chris Garner, you are CEO, right, of Avanti Residential?
Yeah.
Thank you. It's been an enormous pleasure getting to know you, but thank you so much for joining me on the podcast today.
Yeah, I appreciate the opportunity.
All right, that was Chris Garner, President and CEO of Avanti Residential. Chris, what a pleasure having you on the show today. Thanks so much for sharing your thoughts about what's going on in the world and your view of the world, and providing some insights based on your extremely lengthy career in this industry. It's a real pleasure. It's been a real pleasure getting to know you, and also to host you on the show. I hope it was everything you expected a podcast to be. What can I say? And thank you to dear viewers and dear listeners. Really appreciate you spending your time with us as well today. Obviously couldn't do it without you. So certainly hope you enjoyed hearing Chris as much as I enjoyed talking to him. If you have not already, and you would like to read actually detailed summaries of this conversation and others in the series, just go ahead and subscribe to gowercrowd.com or to my newsletter by going to gowercrowd.com, hit the subscribe button, and sign up there. You can always unsubscribe, of course. Okay, that is all I have for you this week. And so until next time, this is Adam Gower signing off.